Now we're going to begin discussing trade and market management. What exactly does that mean? For one, it can mean a lot of different things, and it does mean a lot of different things, and it means different things to different people at different points in time. So what I've done is I've pulled out what I think are some of the most important and salient points that should set the foundation for everybody, every trader, to take the information here and then over time mold it to your situation. Everybody has a different risk tolerance. Everybody has a different amount of capital that they're willing to risk. Everybody has to deal with their own emotions during trading, which we all know is an enormous aspect of trading and investing in the markets. Some of you have more emotional demons than others, but what I will tell you is we all have emotional demons. How we handle them and how we trade through them is what sets apart some traders from others. Before we really get going, you should note that in this section, I'm going to jump back and forth between slides and charts. But the majority of this section is really going to involve conversation and thought process. Since we've already began discussing emotions, let's talk about how to create a risk-free emotionless trade. Now, one thing you'll note is there's really no such thing as a risk-free trade from start to finish. But what we can do is create an environment by using a certain process to create a risk-free emotionless trade on at least a portion of the trade. And you'll see over time that using the strategy I'm about to describe for a number of reasons can create some of your biggest winning trades that you've ever had. It's a pretty simple and reasonable strategy, so I think the best thing to do from this point is go to a chart and I'll just walk through it. We're looking at the chart of the S&P E-mini futures contract. Now, in order to take advantage of this strategy, there's a couple of things that traders have to understand. And there's also some things that I understand that certain traders are capable of and not capable of doing right now, but we can all build to a point where we can utilize a strategy like this. And what I mean by that is in order to employ a strategy where we can take advantage of a trend in the market, yet at the same time book a profit and avoid a lot of the emotions that come with the trade, and also avoid having to watch the trade like a hawk and worry that the $200 you were up 5 minutes ago is now wiped out and you're $100 in the hole. So all that said, the first thing we really need to establish is in order to use this strategy, especially in the futures contract, you can't be trading one contract. Now, I understand that some traders are only able to trade one contract today, but tomorrow that's going to change. And if we're talking about a stock or an exchange traded fund or any other vehicle that has shares, the strategy works the same. So let me get started and explain. Let's say that we've identified a support level where we're willing to buy the S&P 500 E-mini futures contract. There's your buy level. If you're a one contract player, then it should be crystal clear by now that you have to simply set a target for the exit of the trade and move on. There's not much more you can do than that. You set a stop loss and you set a target on the upside, and that's the end of it. There really are no other options. However, if you're able to trade multiple contracts, and in the case of a stock or an ETF, it would be a number of shares. So maybe we have 100 shares, maybe we have 1,000, or some other number. It doesn't matter. It's going to apply the same way. If you're able to trade more than one contract, then this strategy works. And here's what we do. In this example, we enter the trade at 24.11 where the line runs horizontally across the screen. We're entering the trade with 2 contracts or more. Maybe it's 4, 6, 8, 5. It doesn't matter. As long as it's more than one, this strategy applies. On the first contract, we're going to have the same exit point on the upside as we would if we were a one contract player. So we're going to book a profit at some level determined by what the chart pattern is at the time and where the apparent resistance point may be. Let's say the objective was 3 points. Once the target or the objective is reached, what I like to do and what I'm proposing here is you take half off the table. If you're playing an odd number of contracts, you have to make that decision. Let's just assume for the purposes of this explanation, we're using 2 contracts. So we would sell one when we hit the price objective up 3 points. At that time, I'm moving my stop loss to at least break even or even slightly in the money by a tick or 2. By doing this, we've now booked a profit and we can't lose on the trade. We're protecting our capital and we're protecting our profit. Of course, sometimes the market's going to come right back down and stop us out and then take off to the upside. Sometimes it's going to come down and go lower. That's okay. When you use this strategy, you're using it from a mechanical perspective. That takes the emotions out of the trade, or at least the majority of the emotions away from the trade. Think of it as an if-then statement. If the market goes up by 3 points and I hit my first price objective or first price target, I sell half the position, then I move my stop to at least break even, and I see how much more out of the trade I can get. Sometimes you're not going to get any, sometimes you'll get a little more, and sometimes you'll get a whole lot more. And those are the times that turn a good day into a great day, a good week into a great week, a good month into a great month. It's a simple strategy. It's an effective strategy, and best of all, I think it's a strategy that gives you the best of both worlds. Sometimes you're just going to get the entire thing. And in this case, this represents about 10 points. There's going to be times where you're going to get 20, 25, 30 points. It happens, believe me. Not every day, not every week, but it happens. There are a couple of other components to this that are extremely important. So let's go back to the slides and begin discussing about stops and how we manage them. Stops are not meant to be hit unless you're wrong. Now that may seem obvious to most, but let me explain a little further. Many traders don't know how to effectively use stops. I see a lot of traders that move stops around while a trade is happening. They're moving it up, they're moving it down, they're out of the way, they're in the way. They're not exactly sure exactly where to put a stop. That's not the case with you because we've gone over where we're wrong on trades before. But it's certainly worth going over in this section as it applies to trade and market management because there are some different things we can do and different things we should do based on the individual and based on the market conditions at the time. Same chart, the E-mini futures contract, although I moved it over because I wanted to find an area that would be perfect for this discussion. Here's where we're focused. Now the setup is that we have an up candle that begins making bullish consolidation. We know from earlier lessons that any close below the low of this green candle, the trade has changed, we stop out of the trade. Once we see the bullish consolidation begin taking place, that's where we may be interested or become interested in taking a trade to the long side. Right as the market gets into this area here is when we might become interested in taking a long trade. Keep in mind, nothing to the right of the arrow exists as we're looking at the market. So it looks like the market bottomed. We got above this red candle high here. The market appears to be consolidating for a push higher. As we know, there's no guarantees in the market whatsoever. The only thing we can do is trade based on the highest probability we can find. And as long as you do that, you're still going to win the majority of the time with the complete understanding that you can't win all the time. Now here's the point that I want to drive home. Stops are not meant to be hit unless you're wrong. I see a lot of traders enter a trade and they put in an arbitrary stop. The stop is 2 points. In this case, if we put a stop 2 points away from the entry, that would still be inside of the green candle. We know that it's okay if the market goes and tests lower portion or lower part of the green candle, but can still remain in the bullish pattern poised for higher prices. So in effect, we could be stopped out of a trade that's going to work out to the long side. We stopped out at the wrong level, which is why I wanted to drive the point home that the only reason to stop out of a trade like this is with a close below the low of this green candle. You got it here. That was the shot across the bow. There's no guarantee the market's going down from there, but the trade has changed. Therefore, I want to move out of the trade because the probabilities are no longer the same as they were when we entered the trade. Now, here's an important point. If you have a bullish pattern like this, however, the stop, which would be the low or a close below the low of the green candle, if that level is too far away for you from a risk perspective or a capital preservation perspective, if you're just not willing to take that kind of a loss, because in this case, if it was too many points away from what you're willing to accept as a loss, then don't enter the trade. You're always going to be better off entering a trade, obviously at the lowest possible price or towards the low of the green candle in this case. Now, this one didn't work out, but many of them do. So patience pays, waiting for an entry point that you're comfortable with. If you don't get it, pass on the trade. There's always another trade around the corner, which is part of the reason why I wanted to show you that the same techniques, the same principles apply on stocks, ETFs, and the like. It broadens the horizons. It broadens our opportunity to find trades that are right for us. Sometimes there will be instances where we just don't have this kind of a stop out available. There will be times when you want to buy the market or sell the market at a particular price at what you may feel is a very, very good resistance or support level for the market, but not necessarily will you have a defined stop as clear as what we just went over. So what do? It's simple. We use a point value as a stop out. Let me explain. Let's say we were interested to sell short the market right here. We had a doji candle put in. We had 7 candles to another doji expecting a change in trend. Now we know where our stop out is. Our stop out is a close above the high of the doji candle. But what happens if we don't get that opportunity? What happens if the market just turns around and takes off to the upside for whatever the reason is at the time? We know that happens. We know it's going to happen again, and we have to be prepared for it. So proper risk management is that we still have to have, in the event we don't get a chance to wait for the close of a candle, we still have to have a point value in mind. Maybe it's 3, maybe it's 4, maybe it's 2. Every trader has to decide what's right for them. But you have to abide by your stops and move on. Sometimes it's just going to happen that way. The idea you want to keep in mind is you have to preserve capital so that A, you don't lose too much money on any given trade. B, you don't get demoralized, which prevents you from taking the next trade. We're going to get into that later. And C, you have to be able to come back to fight another day. You have to accept the fact that you're going to have losing days. Hopefully they'll be at a minimum. Hopefully they'll be few and far between, but you're still going to have losing days. That's just the way it works. We have to learn to accept it and move on. Another way to say that is you have to learn how to lose. It's not a fun thing to learn, but you have to learn how to lose. You have to learn that you will lose and just accept it and move on. Next up, trailing stops. There are a handful of ways that you can utilize a trailing stop. There are automated trailing stops and there are manual trailing stops. An automated trailing stop is where you set within your trading platform a specific trailing stop. Maybe the trailing stop is 1.5 points behind current price. Maybe it's more, maybe it's less. The amount doesn't matter. What happens is the automation will take over, take the emotion out of your trade. What you're going to end up doing is letting the market stop you out without having you make the decision. Takes the emotion away from it. There's no second guessing. There's no moving stops around. You're letting the market make the decision at the right time for that trade. Let's say we set an automated stop 1.5, which is 6 ticks behind current price. Let's say we entered a trade right here. We're good, right? We bought it at the right price. Let's say our first target was right near the top of this red candle. We're going to book a profit. We bought 2 contracts. We're going to book one at the black line. Maybe we'll get a big runner. Maybe we won't. But in this case, we've elected to use a trailing stop. The way this works is, on establishing the stop, it starts out 6 ticks behind current price. Each and every time the market ticks up 1 tick, the stop moves up with it 1 tick. What a trailing stop doesn't do is it doesn't move down. So if the market takes off to the upside, the trailing stop will follow the market 6 ticks behind current price. As soon as price pulls back, the trailing stop gets narrower and narrower until the market comes down 6 ticks from wherever it made a high, at which time the trade would be over. You would be stopped out of the trade. You're letting the market make the decision. So we booked a profit, we've got one in our pocket, and the trailing stop started at least at break even. So you're guaranteed a profit, and you're also guaranteed not to have to make a decision, hence a risk-free, emotionless trade. What about a manual trailing stop? What does that look like? Let's go back to the top and assume, for the purposes of this lesson, we got a perfect entry at the top of the market at this point in time. We're short the market and it proceeds lower. The way I like to utilize a trailing stop in this fashion is to trail the market candle by candle after the close of the candle. Here's what I mean. Let's assume that I've booked a profit at some point towards the bottom portion of the first red down candle. At that time, my stop is break even. The candle closes and the next candle opens. Technically, my stop is still break even until the second red candle closes, at which time I move my stop a tick or two above the high of the second down red candle. The next candle is open. What do I do with my stop? I move it a tick or two above the third red candle. And you repeat the process until you're stopped out of the trade. Just like any of the other strategies, sometimes you'll be stopped out immediately. Sometimes it'll turn into a big trade. You never know exactly which one is going to happen when. In this case, we would have gotten a lot of this trade or a lot of this move. We would have been stopped out right where the black line is above the last down candle. Just like the trailing stops, it takes much of the emotion away from the trade. You're trading mechanically and you're treating it as a process. It's a business. Businesses have processes. Trading is no different. You just have to be consistent with it. You have to do the same thing over and over and over again, as long as it's the right thing. Don't do the wrong thing over and over again. And that message comes from Captain Obvious. The next thing I want to discuss is time. Time is extremely important. What does that mean? We need time to have a trade work out. Sometimes it'll happen immediately, and sometimes they just take time. And it's very difficult to give a lot of the trades the necessary time to work out if our emotions are getting in the way. That's one of the reasons why I like these strategies that takes the emotion away from the trade. I want to explain further, so I move the chart to an area that really magnifies the point. Let's focus on the green candle, which is a reversal candle. And granted, this was no easy trade. It's a hypothetical example, but you'll get the point. Let's say we entered a trade based on the reversal candle. We waited for some kind of a pullback, and we got in the E-mini contract on the long side. Let's say we entered the trade right where the black line is on about a 50% retracement of the reversal candle. As you can see, the market went a lot lower than that, but never closed below the low of the green reversal candle. So technically, the reason for the trade still exists, even while the market was all the way down here. Here's what I want you to realize. How long did it take for the market to get all the way up here? It took about an hour and 40 minutes. Now, I recognize some traders are really in this for the scalp trading end of it. I understand some traders don't want to be in a trade for an hour and 40 minutes. But the point is, you need time to let the market do what it's going to do. It's like a cake in the oven. You have to give it time to bake. The market goes up, the market goes down, it goes back and forth. It tries to whip out the weak hands or shake out the weak hands. But if you follow the rules, and in a case like this, stay in the trade until you get a close below the low of, in this case, the green candle or the reversal candle, then you give yourself a chance for higher prices. In order to be successful in this business, you really have to learn how to get multiple points out of a trade. Trading for 4 or 5 ticks, a point, point and a quarter, point and a half, that's not really, over the long term, going to make anybody a bundle of money unless you're trading a significant amount of contracts. You need to be able to let the market do its thing and take advantage of time. If the market's finding low or the market's finding a high or a resistance point, it doesn't necessarily always turn on a dime. Sometimes the market will come back to retest a level multiple times and then trade away from it. You need to give the market its due time. And by utilizing some of the stop loss techniques that I've discussed, you can give the market the time without having your emotions get in the way. Nobody ever said this was an easy business, but what I will tell you is it's an achievable business if you have a set of rules, you follow the rules, if you have a process and you follow the process and you're consistent. This business is about rinse and repeat. So remember, you want time on your side. Time is extremely important.